This is actually a video that is 100% driven by the audience of one rental at a time. If you don't know already, the one and only Millennial Mike scours the comments that all of you leave and pulls out the spicy ones, the ones that get asked repeatedly, and just ones he wants me to get embarrassed on, which is always fun. So let's thank Millennial Mike for doing this each and every week. How you doing, buddy?
I'm doing good. I'm actually in Vegas right now. That's why the setup's a little lacking today. I'm hanging out with Dion and the Lumberjack. So
Awesome.
yeah, well, we got some good questions and some good topics today.
All right, well let's just get into it.
Sure, sure, sure. All right. Well, for to get us started, a lot of people have been talking about custom home builders and luxury builders, and essentially just any new build projects taking a hit. And you've been famous for saying that you think luxury and high-end homes are going to be some of the things that take a hit. So the question is from Renee Arces 704. She goes, Mike, what are your thoughts on the custom home builder market? Does that fit into the luxury category? And would you expect prices to fall, or do other things like the region make more of a difference?
Yeah, so I think it's all about price point for me. It's never quite that simple, but when we're talking to an audience that is around the world, I have to come up with some metrics. So everybody should know the median price for their market or their area, right? So again, if this custom home build is 2x the median, that's the line of luxury for me. And if that's what we're referring to, like, so the median's 400. So this is a brand new custom home at 800. Yeah, it qualifies. In fact,
Mm.
in Vegas, the one and only Brian Lebo sent me a note yesterday about a home builder that originally had a price listed at, I think it was 1.9 million. I think it was 1.945 million, just cut to
Oh,
1.59. So a $355,000 cut. It's about 15%, but still it's pretty bad. So yeah, I think the number one buyer's market is anything luxury. And to be clear, I think that is cars, watches, all of this stuff.
right.
I think a lot of people balled out and now they need to sell these things for pennies on the dollar. And I think they made too much of them. I think luxury, there's just too much of it. And
Mm.
yeah, so I think anything 2x the median is in trouble, whether it's existing or a new build. It's already
Mm.
happening. Orange County is crashing, Vegas. It's happening in New York. So yeah, I think anything that's luxury, maybe outside of Florida, is in trouble in my opinion.
Okay. Interesting. So, in your original response to this question, you had said it depends on how the builder funds the deal. Do they have a
Yep.
contract and funds up front, or are they building and hoping a buyer shows up? Can you elaborate on that?
Yeah, so some home builders only build when they're paid, right? You basically you bring a plan to you bring architectural plans ready to build, you own the lot, and then the builder's just getting paid during the job. That's not a big part of the housing market. A lot of luxury home builders will go out and I think it's called build on spec, speculation, and hope a buyer shows up.
Mm.
That's what happened in Vegas, right? The Vegas example, right? They
Right.
built something, they built a community, 1.945. They can't get anything. So now it's 1.59. They want to get their cash back. So yeah, there will be some builders. Like if you're a builder that only works when you're paid, you're going to do just fine.
Mm.
But that's not most of the market.
Interesting. All right. Well, moving on, we have little more simple, basic question from one of our newer viewers about running the numbers on a property. And this one is from Hank Duncan 2665. And he says, Hey, Mike, when you say a property needs to cash flow from day one, does that assume the 20% down conventional loan? How do closing costs and loan origination fees weigh in? Is this the type of info in your books or in your book?
So a couple of things. No, the book is one rental at a time. The book is just my story. It's not the math. The course,
Mhm.
as you know, is where the math is and the formulas are. But I always give it away for free. So again, the calculation of yield is two numbers. It's a division. So there's a numerator and a denominator. The denominator or bottom number is down payment, so 20%, your closing cost and origination, and what wasn't in that question, make ready, right?
Mhm.
If you're going to be buying a fixer upper and have to spend 12 grand before it's rent ready, I want you to include that 12 grand. If you buy a turnkey or something that is already rented, it can be zero.
Mhm.
But make ready is often a missing cost that wasn't in that question. And then obviously the numerator is just your expected yearly cash flow, rent minus
Mhm.
all expenses, times 12, because usually people do that on a monthly basis, and that produces a percentage, right? So that's
Mhm.
the math, simply said.
Yeah, the way that I explain it to people is it's just whatever your yearly cash flow is,
Mhm.
yearly profit cash flow is divided by your all-in costs. Whatever, I mean, like as a long distance investor, did you have to take multiple flights out there? Well, that's part of the
Exactly.
cost that it might have taken to acquire that property that could factor into making that property better or worse than a local property. So you got to take that all into
Absolutely.
consideration.
Well done.
Okay, interest rates and the national debt, a reoccurring theme that we see all the time. And Quicksilver 39 says there's one thing that you guys seem to forget. The federal government is insolvent at 5% interest on the debt. I would like to hear your thoughts on government debt load and how much interest we'll be paying if the Fed holds 5% for all of 2023.
This question annoys me.
You've gotten it a few times.
Yeah, a few times. So this is when this is when people read, other kind of everything's horrible, the world is ending, and they don't understand the mechanics.
Mm,
So if our interest rates, the Fed stayed at 5% forever, that's going to be painful. You're going to have to raise taxes or cut spending. But the reality is our debt's not refinanced every single day. That's the key. The Fed can hold rates at 5% for a year. And yes, some new debt will be at 5%, but most of our debt doesn't reset in a year. It's financed at 10 years. I think the average duration is 8, if I remember. So again, holding debt at 5% is not fun. Our interest payments will certainly go up, but not everything goes up. It's the people that think that don't understand. It's frustrating because I see it almost every week. Oh, we're going to be
right,
insolvent and
right.
the government's going to stop functioning and the dollar's going to go to nothing because rates are 5%. I'm like, God, it's not how it works.
Yeah.
Not how it works.
So my question, follow-up question on that would be, okay, so the government obviously isn't going to roll over all their debt the second that interest rates hit 5 or 6 or 7%. It's not like all the debt we have gets rolled over instantaneously at the new rate, but it does start to, over time, you would start to see things.
Yeah.
So, but the question that I have is obviously back in the 70s and 80s, I mean, we had high interest rates that continued to climb up to 18% for a long time. Does this questioner have a point that would you think it would be possible for us to like climb up to 10% and stay there for 5 years, or could we maybe just spike and hit it briefly to fight inflation and then fall back down?
I think actually you're focused on interest rates, and where I think this individual is right is he's focused on the debt load, right? Our debt load as a percent of GDP today versus the 70s is night and day. I think the 70s, our debt load compared to our GDP was something like, I don't know, it was low, 50, 60%. We could easily fund ourselves. Today it's 130% or something crazy. I mean, it's just vastly different. Um, that is a problem. That there will be a day that comes due, but it's not tomorrow. It's probably not even this year that's a problem. But it will be a problem eventually, right? You can't just keep running the debt up that fast. Um, as far as interest rates go, I I don't think there's a number. Like, let's just use your example. Let's say interest rates spiked up Monday. The Fed came out, total rug pull. We're going to 10%. We're going to break inflation. That would hurt. Asset prices of all ilks would come crashing down. The economy would go nuts. Unemployment would spike.
Mhm.
And oh, by the way, the Fed would cut in 90 days.
Mhm.
It's not a problem. I
Right.
mean, and oh, by the way, just because the Fed funds rate is 10% doesn't mean the 10-year treasury. Dude, if the Fed funds rate went to 10%, I would think the 10-year treasury would fall. And that's the debt. The federal government doesn't finance itself on the funds rate. They finance themselves in the bond market. The 10-year note, so the Fed funds rate today is 4 to 4.25, I believe.
Mhm.
The 10-year treasury, last I checked, was at 3.6. That's where they're financing. They're financing in the
Right.
debt market. So
Right.
Yeah, there's a lot of pieces working together. Is the debt a problem? Are we running a fiscally irresponsible economy? Yes. Is it going to go bankrupt because we're at 5%? No. At least no in the short term. So
Well, to me, this sounds like one of those examples of why some of these questions are only able to be answered by someone with an economics degree and 20 plus years in the market. Okay, let's see here. Getting to negative inflation and Michael Burry's crazy recent predictions. So at Justin Chapman 5876 says inflation could turn negative this year. It would just require a massive economic crisis. Your response was very true. So my question is, hypothetically, could you take us through some sort of massive economic crisis scenario that could actually lead to negative inflation occurring? Is it something as extravagant as World War III? Is there something a little bit more likely that actually could get us there?
pandemic 2.0, we
Okay.
shut down the
Okay.
economy again. I mean, there's no certainties in the world, only probabilities. And if we
Mhm.
have something that basically drives unemployment, again, remember what people don't really remember is I think it was March to April, unemployment went from 3.6 to 12% in a month. If something happened where that occurred again, yeah, we could have deflation. Absolutely. Is it probable? No, I think we've learned our mistakes. I don't think we're going to shut down an economy again. But is it possible? Sure. I mean, anything's possible in this crazy world that we live in, but it would have to be something of that size, in my opinion.
So I watched a recent video with George Gammon, and he had been talking about how when we look back 20, 30, 40 years from now, like we look back at the 70s, we're going to look back at the 2020s as a inflationary decade. But he did say that it was possible that we would see pockets of not just inflation slowing, but that we would see pockets of possibly deflation as the Fed or people in charge of the economy start to say, oh, maybe we've got this under control. Maybe we've got it to the point where inflation's coming down. Let's ease back up off the brake or the gas pedal a little bit. Do you foresee anything like that?
Well, first off, I agree with him. And it's, in fact, what I put out 18 months ago that I think 2020s are going to be the year of inflation. And that's why I told everybody in 2020 to go get fixed rate debt. So these are all things that I saw coming and called over a year ago. So I agree that when we look back on 2020s, it will be the year of inflation. Hence, I have a shirt that says, I use inflation to get rich. Ask me how. So again, I really believe that's true. And I put my money behind that. Second, I think I watched the same video you did. I watch a lot of George's stuff. He puts out some very thought provoking things. I don't always agree, but nonetheless, I think he articulates things in a kind of 1, 2, 3 way that when I disagree, I could say, "Hey, I disagree with point two." Right?
Hmm.
That's where you and I disagree. So I like what he does. I like to watch stuff um, that causes me to think, and I think George causes me to think. So shout out
Right.
George Gammon
Right.
for that. Um, I do think human nature is repeatable and it's predictable. And I think there's a lot of things with the Fed that you could see coming. One of them is them backing off. On my daily financial news today, I talked about CPI expectations for Thursday being 6.6%.
Hmm.
If it came in low, let's say it's 6.3, 6.4, you're going to see the Fed start feeling their oats. Like, damn it, we kicked this in its teeth. The job markets is still strong. We got this thing. So they're going to slow down. Could something cause that to be early? It could. I do think Jerome Powell is a student of history, and I think he will err on the side of going one too far
Hmm.
versus one too early. But
Right.
again, those are probabilities, not certainties. So, um, yeah, I think Jerome Powell has done a very good job of telling us that he's going to go one step too far, and then if something breaks, come back. I really think he's afraid of going one step not far enough, or whatever, however you would say that. So we'll see,
Okay.
and we'll see soon. That's the beauty of this. We're almost done. I think we're
Yeah.
done raising rates in March. Could it be April? Sure, but we're almost done. This is going to get fun.
Okay, so last week, and for those of you who don't know, most weeks when Mike and I do our reaction series, people send me or him a bunch of videos for us to react to. This week, because I'm in Vegas hanging out with the fellas, we don't have quite as much time. But last week, we reacted to the Fundrise CEO talking about his positive outlook for the 2023 economy and how things are actually going to start getting better probably in the spring. Interest rates will come down, the housing market will recover, bounce back if there is any declines. Tebow Time 46 says, these guys are so out of touch with reality. Do you think a CEO whose company owns 20,000 units will say anything negative about his market? The real estate market is going to crash hard this year. Record equity depreciation easily 10 to 20%. Mike, your thoughts?
Well, first off, obviously I disagree, right, with the call of 20%. I don't think I need to belabor that point. Second, I think a lot of companies and billionaires talk their own book, right? I think there's some fairness in that. But if you actually read the article, he laid out a what relatively well thought out process. I didn't agree with it. Obviously, I reacted in the video like, I'm not sure, right? I don't quite see it that way, but it's possible. Um, I think folks that are in the camp of everything's going to crash and it's going to crash. Again, let's just talk to 20% in a year. That would be 2 times worse than any other year ever. So, think about that. And oh, by the way, go look up the word price inelasticity. Housing is sticky. Go learn about these things, because we're not talking Rolex watches that are down 20% already. We're talking about a
Right.
home where people live. So, I mean, some of these things are just frightening. But yeah, I mean, I understand, right? It's kind of like a CEO of a car company saying his car company is going to be worth as much as Saudi Aramco and Apple combined. He's
Right,
probably talking
right,
his own book. But
right.
you're going to point at that CEO and say he's a god, and you're going to point at this guy and say he's full of shit. You guys talk out both sides of your mouth, so it is what it is.
Yeah. And so, I mean, I can understand a little bit what he says because the only CEO I've ever heard of who says something like, well, you know what? I actually do think Tesla stock is a little bit overpriced, is Elon Musk. And then the market takes a sharp turn immediately after that. Most
Well,
of the time, it is the CEO's
yeah.
job to be somewhat of a cheerleader.
Mm-hmm. Exactly. Exactly.
All righty. Doing the work. Another question from somebody who's relatively new. So from Vince2405, he says, work to find average. What does that mean?
Mm. This is probably the most important thing I try to teach and talk about and discuss. So it's a great question. We probably should hit it, I don't know, every 3, 4, 5 months just to get the new people caught up. But I believe real estate investing is a skill. And because it's a skill, it can be learned. I think most people don't understand what that is. So for me, step one is to define your buy box, 3 bedroom, 2 bath in this part of town. You look at that buy box every day and do the work, right? Figure out yield, right? Is it negative, positive, whatever it is? Usually by day 90, sometimes by day 150, so 3 to 5 months, you go, oh my God, I now understand that the average home in my buy box produces 5%.
Mhm.
That's what average is. And once you know average, you're not done. Once you know average, you now have permission to write great offers. So let's talk about that. Again, using 5 as average. A great offer in your market might be 8, might be 9, but that's the deal. Everything about one rental at a time is figuring out average and then only doing great deals. Most of us can do one deal every year or two.
Mhm.
So why not make it a great deal? Don't settle for average. So that's kind of my quick synopsis.
Yeah, if I was going to explain this to the individual to help them out, when you very first start looking at your market, like when I started to look at my market in Gary, Indiana, I started running the numbers on lots of properties, and I started to figure out that most properties had about a 10% cash on cash return or yield, with about $180 in positive monthly cash flow. That's what most of the properties on the market had. So that's what was the average. Well, as you continue to run your numbers, every now and then, one is going to jump off the page
Bingo.
because instead of a 10% cash on cash return, it's 18. And instead of 180 a month in positive cash flow, it's 250. And now you're saying to yourself, holy smokes, this one is above average, or what we used to call good, but in this case, this was actually a great deal. And that's when I said to myself, I understand what good and great are because I have sure knowledge of what average is because I've looked at so many. That's why you got to look at your market every day because within those numbers, they actually can fluctuate a little bit as the market changes. So you need to look all the time.
Amen.
At the very last question, we have another kind of simple one, but maybe just one from someone who's curious about your experience, Mike, with 20
Mhm.
plus years of buying properties. So at Hank Duncan 2665 asks, what percentage of the time do deals go south during the inspection or appraisal period in your experience?
Oh wow, I don't remember that question. So I can only use my experience. So I had another question um, in the last week or so. I'll kind of time together, right? How many times is my offer accepted? So I'll kind of walk through the whole thing, right? So I write lots of offers and I only write great offers, which means most of the time I get told no. Sometimes I get told hell no, right? Because I only want a great deal and I'm picky enough to wait. So I would say my conversion currently is running. So I write an offer about 10% of the offers, because again, the market is changing as we speak. About 10% of the time I'll get a counter. And then about, I don't know. So now so I write 100, I get 10 counters. I probably get two in the contract, right? So that's the ratio of a deal. Now I'm in contract. Now inspections can start. Now, for me, I usually have somebody I trust go through it, maybe a contractor, depending on the condition. I usually have it known up front. So I don't currently, the last decade or so, I have probably had three properties probably fall out of the 50 or so I bought for various reasons. Like one was a non-permitted structure that they said was
Right.
permitted, so they lied. Um, oh, one had more termites than inspected. Um, and I forget the other one. There was another one I think that fell out. So not very often. However, the first 10 years of going through this, so when I didn't really have a team and everything dialed in, I would say 30% probably fell out. So 3 in 10, where today it's maybe 1 in 10, 1 in 20. So that's kind of my process.
Yeah, my initial thought to this was, as far as losing properties to appraisals, especially right now, it shouldn't be happening because you should be offering well below what people are asking. You should be getting
Yeah,
cutthroat
I
with it.
yeah, I missed that. I don't recall ever losing something to an appraisal, because I only
Yeah, and
do
I've
great
never had
deals,
an
and
appraisal gap.
I don't chase. I don't. In fact, I think if you took all of my appraisals, I think I average probably like 98% of appraisal, because most of my stuff is bought below appraisal. So
Mhm. Yeah, and typically for me, when I'm buying a property, it's a little bit easier when you're doing single family rentals. As soon as you start to get in duplexes and higher, it's harder to get an opportunity to see the property because you have to notify the tenants living within it. But a lot of times the single family rentals are empty. So I'll have my real estate agent look at it, but then I'll also have my property manager look at it. So I've already had two eyes worth of inspection. So when I actually do the inspection, there's a lot less that's going to surprise me. Although I have dropped out of a property before because I was like, oh no, I don't like the roof. The roof is no
yeah,
good. I'm not
no
dealing with this.
bueno.
There's lower hanging fruit that I could go pick. This isn't worth my
Yeah,
time. So
perfect.
okay, Mike, we have one last question. The last question is, again, I'm here in Las Vegas with Matt, the lumberjack landlord, with Dion Talk Financial Freedom, and we're enjoying ourselves. We're having a good time, and we know that the one rental at a time live event will happen in Vegas at some point. So we want to know, are there any updates as to when you forecast that happening and when you're hoping for that to happen?
So again, this is all coming down to having 50,000 subscribers. We just crossed 41,000. I would say I'm only averaging about 200 new subs a week. So we're talking 40 weeks, right? So
Okay.
I
Okay.
do hope
So
it
end of the year.
accelerates. Yeah. I
Right.
my goal is August. I'd love to do something by August, but the numbers currently don't support that. I don't ask
Mhm.
for it enough. Like, subscribe, comment. I need to go on more channels to kind of push, the goodness of one rental at a time. So there's things I could do to
Right.
make that go faster. But at the end of the day, if you like what we're doing, you like the daily financial news, I need you
Mhm.
to help me. Ask your friends, put it in social media, invite them to come over.
Yeah, folks, it does actually help big time if you share the video on any type of social media website. If you like the video, if you leave a comment down below. I mean, the whole point of this is for us to get your questions answered. So ask them, leave them in the comments, send me a DM. If you're watching good short form content out there or bad short form content out there, send it to me, because sometimes Mike and I like to roast the guy and sometimes we agree with them. So, please send that stuff to us so that we can develop stuff that's better for the audience and continue to grow the channel.
There you go. Thank you so much for doing this. I appreciate you. If your son's still sleeping,
Yes, he's still knocked out in the bed.
nice. We did it. All right, man. I
I know.
appreciate you. Enjoy having Dion and Matt. Take care.
Thank you.